Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Phil Mackintosh, chief economist at Nasdaq, to discuss why rates have suddenly made a move downward. That's something somewhat encouraging, right? And we've seen it sudden just over the past couple of weeks.
Yeah, I mean, it seems like only last week we were talking about how rates had gone up over the 6 weeks before that. And all of a sudden this week we've started to see rates come back down, at least on the long end of the curve. So we've seen about 0.25% move down in literally the last 3 or 4 days, which is big considering we're talking about a 10-year interest rate.
Well, the key question is, right, what are expectations for a Fed funds rate? What are the expectations?
Yeah, I mean, obviously they're going to be data driven. And so what's happened is in this week, we've seen a little bit of data that shows the job market weakening. And we've talked in the past about the fact that there was almost 2 jobs out there for every 1 unemployed person looking. That's now come down to 1.5. And people are feeling a little bit more nervous. They're not walking away from jobs like they used to. It's a little bit harder to find new jobs. So even though the unemployment rate isn't going up yet, there's definitely a lot of pressure coming out of the sort of demand side for finding workers.
And let's take a look at that chart here. You can see that 1.5 job openings per unemployed person. And to your point, the market easing without unemployment going higher, and that's a perfect scenario for the most part.
That's what the Fed wants, the job-full recession, right? Where you don't actually make the unemployment rate go up, but you take all the pressure out of the employment market. And so what's interesting is looking at the really long end of the curve is where we're seeing rates maybe coming down later next year, rather than talking about hikes for the rest of the year.
So it sounds as if they're going to pause, maybe higher for longer, but not cutting for 2023.
Probably not cutting even up until December, and the markets are sort of a little bit hesitant, but saying probably not one more hike. So we'll probably be paused from now right through to the end of December, and then the outcome is sometime in next year we should see GDP start to slow. We should see the employment market, if it keeps weakening, really take the pressure out, and then the Fed might have to start reducing rates to make sure it doesn't overdo it.
Well, the Fed, when it comes to unemployment, they're also concerned about wage inflation as well. Have you seen any downtick in that?
Yeah, wage inflation's been coming down. It's still relatively high. But what's really important, I guess, is the leisure and hospitality sectors, like some of the sectors that were really short-staffed and had to pay 15-20% increases to get people in, those wages have come right back down because the shortages in those spaces seem to have gone away.
Not current employees, though. I can't imagine that you're going to take away someone's. I mean, that's not a transitory thing once you have, an agreed upon wage.
Yeah, so everybody's wages have been going up. Because inflation's coming down, it's got to the point now where the wage rises are kind of offsetting inflation, which is good for all of the people that have kept their jobs, because at least they can still afford the same as they could afford 2 years ago. The people that have left have actually seen pay rises going in, but the new jobs for people now are falling really quickly, so the wages for them are falling really quickly. So the premium that people were paying for the quiet quitters has completely gone away.
As a consumer, however, if we see production costs come down, if we see inflation come down, if we see wages come down, in theory, prices for products should come down. Do you think, the companies are going to be quick to take prices down?
Good question. In practice, inflation's coming down quite quickly. Really what's holding the core CPI up, which is holding the whole CPI up, is rent. And rent is all about where we live. A lot of the products have come down in price, or at least they're not going up anymore. Your question is, what are companies going to do? And at the moment, it looks like their margins are holding. So probably not going to be discounting product and causing deflation on the product side.
I would imagine the only way that would occur is if competitors start to bring prices down. I don't think they'll necessarily do it in interest of...
Or if you have a huge inventory build because we just stopped paying for things.
Right.
And we've seen with the consumer spending data, the consumer spending has been really quite strong still. So I think companies are comfortable enough to know that if I make stuff, it will get sold, and I'm not going to have to discount a batch of it.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.